Today's topic is PMI, or private mortgage insurance. We're going to give you an in-depth look which will help you understand what it's for, what it potentially costs, and if it's really worth it. So if your down payment is less than 20% of the home's purchase price, you may have to shell out for this extra insurance policy. Private mortgage insurance can help you buy a home without having to save for the traditional 20% down payment. The concession you'll make for this is by paying an additional monthly premium for mortgage insurance. PMI is required for conventional mortgages with smaller down payments, but helps first-time homebuyers become homeowners sooner. So what is PMI and how does it work? PMI allows buyers the opportunity to purchase a home using a conventional mortgage with less than 20% down of the required down payment, and it also protects investors who offer these lower down payment financing options in case you would go into default. So if you're unable to make 20% down payment, investors consider you a riskier borrower with a greater chance of defaulting on your mortgage. If that were to happen, the lender could use the escrowed PMI payments that you paid until default to recoup some of their losses. So the PMI acts as a sort of insurance policy for the investors. Do all home loans require PMI? Though PMI is typically required only for conventional mortgages, other specialized mortgage types have their own version of it with their own set of requirements. So conventional mortgages, if you put less than 20% down on a conventional loan, as we stated, you expect to pay PMI. There are some non-PMI options, but those typically include higher interest rates, which could actually cost you more in the long run. FHA loans allow you to borrow with as little as 3.5% down, and these also have a monthly insurance premium, or what they call an MIP. So MIP also requires an upfront payment, which is factored in at closing, and the monthly or annual payments thereafter, so it's not as straightforward as a conventional mortgage with PMI. Borrowers with a down payment of 10% or more will pay that MIP for 11 years, while borrowers with less than 10% down will pay that MIP for the life of the loan. Although USDA loans do not require a down payment on their mortgage, there is still a mortgage insurance requirement with upfront and annual fees attached. An upfront fee of 1% of the loan value is due at closing, and the annual fees of 0.35% of the loan amount are due annually but are broken down into monthly payments. Though USDA mortgage insurance cannot be canceled, it is typically more affordable than the FHA MIP, and interest rates tend to also be lower, but also qualifying for these USDA loans can be quite tough. Now, with VA loans, there is no mortgage insurance requirement for VA loans, but the borrowers will have to pay a one-time origination fee, which can vary between 1.4 and 3.6%, depending on their down payment amount. This fee can typically be rolled into the loan amount, but it can be substantial depending on the loan size. The cost of PMI. Borrowers with PMI pay between 0.05 and 1.5% of the loan amount on average each year, or between $30 and $70 monthly per $100,000 borrowed, according to Freddie Mac. If you take out a $250,000 loan with a 5% down payment, PMI would add between $1,188 and $3,563 annually, or roughly $100 to $300 tacked onto your monthly mortgage payment. The variation of the cost of PMI depends on how much you put down, your credit score, and if you're part of a certain program. Credit scores for PMI start at 760 or higher, and these will be your cheapest option, and then it goes down from there about every 20 points in credit score. In terms of PMI, credit score is the key factor, especially with less money down. So here's a real-world example. We have borrower A. So let's assume borrower A has a credit score of 760. They make over any income limit for first-time homebuyer programs, so they're not using any sort of program. This borrower is putting 5% down on a home on a $300,000 purchase price. In this scenario, the PMI will be factored into the loan amount, which is about $285,000. the PMI will use a rate of 0.35% of the loan amount, and the total will be $997.50. Then we take this number and divide it by 12, number of months in a year, and you have a monthly PMI payment of $83.13. Now let's look at borrower B. Keeping everything the same except for the credit score, which will change to 700, borrower B will use a PMI rate of 0.071% of the loan amount, or a total of $2,023.50. Take this number and divide by 12, and you have a monthly PMI payment of $168.63. This is an easy example to show how credit score can affect PMI monthly pricing. How to lock in a low PMI rate. Credit score. The higher your credit score, the better chance you have in locking in a lower mortgage interest rate and PMI premium. Down payment. The closer you can get to 20% down, the lower your PMI rate will be, and the faster you can get rid of it. Occupancy. Owner-occupied properties get lower PMI rates than second homes or rental investment properties. When can I stop paying PMI? PMI is typically no longer required once you have at least 20% equity in your home, whether from paying down the principal or an increase in your home's value. However, some servicers may have further requirements you must meet before satisfying your PMI obligations. These might include making a set number of mortgage payments, getting a new appraisal, or owing less than 80% of your loan principal. Though this process may differ slightly from each servicer, you can usually request PMI cancellation in writing once you have at least 80% loan-to-value threshold. You must meet specific requirements as laid out by the Consumer Financial Protection Bureau, which include a record of good payment history, current loan status, so it's not in default, the equity must not be subject to a subordinate loan, and you should also have proof of value if requested, such as getting an appraisal. Borrowers with Fannie Mae or Freddie Mac mortgages may have a different threshold for removing PMI if the mortgage is between 2 and 5 years old. For these borrowers, the equity must be at least 25% before PMI can be terminated. The benefits of PMI. Although PMI adds additional expense to your monthly mortgage payments, in some cases it may be worthwhile. You can buy a home sooner. For potential homeowners, especially the first-time homebuyers, high down payment requirements make owning a home seem unachievable. With down payment requirements as low as 3%, borrowers can buy a home sooner. You're able to build wealth sooner. Owning a home can help increase your net worth. Purchasing a home sooner with the help of PMI can also help you build equity faster, which could in turn help you eliminate PMI sooner. It's only a temporary cost. Once you've reached an 80% loan-to-value ratio, or 75% for Fannie Mae and Freddie Mac loans in that 2 to 5 year range, you can request the removal of PMI. If you do not request it, lenders are required to automatically remove PMI when you reach 78% loan-to-value based on your original loan setup. PMI is currently tax deductible. If you file an itemized tax return, you can currently deduct private mortgage insurance through your tax return, and this is through the end of 2021. This may get extended. Downsides of PMI. Although PMI can help you secure a mortgage with a lower down payment, there are some disadvantages to consider. It's an extra premium. No matter how low your PMI interest rate is, you'll still be paying extra expense each month through this PMI payment. PMI rates may be high. PMI rates are set based on your credit score, your home occupancy, your down payment amount, and equity appreciation. A high PMI rate might raise your monthly mortgage payment by more than you can comfortably afford. Canceling PMI takes time. You are still required to pay PMI until the lender cancels it at 78% loan-to-value. When requesting cancellation sooner, you'll often need to make a formal request in writing which can take time to process and remove. You also may have to pay for an appraisal if your lender requires one. Is PMI worth the expense? There's obviously a trade-off here. PMI increases your monthly mortgage payment, but can also allow you to buy a home with a lower down payment. Home buyers like to avoid PMI because they feel it's a waste of money. In fact, foregoing buying a home altogether because they don't want to pay PMI premiums. Now, this could be a mistake. Data from the housing market indicates that PMI yields surprising return on investment. Let's take an example scenario from a homeowner, let's say borrower A, from our example earlier in the video. Imagine they bought that $300,000 home with 5% down. Again, their PMI cost is $83.13 a month, according to that scenario we built up. And remember, PMI with conventional mortgages are not permanent. PMI will drop off with increasing home value and decreasing loan principal. Another note to remember, you can cancel PMI, that mortgage insurance, on a conventional loan when your mortgage balance falls to 80% of your home's purchase price. It'll automatically drop off at 78%. So in this scenario with borrower A, in 5 years they requested to have PMI removed from their servicer by doing an appraisal, and that appraisal came in at $320,000. That homeowner snapshot at the end of year 5 looks like this. Their current value is $320,000 on their home. Their principal balance remaining is $254,525, which means they have quite a bit of equity there. In 5 years, the home has appreciated $20,000, and the final PMI cost is $4,988, meaning the investment would net over $15,000 in appreciation simply by investing less into the home and utilizing PMI. And of course, the home could potentially appraise for way more than that. $20,000 in 5 years is probably a low scenario. It's hard to get that kind of return in the stock market, retirement accounts, or any other financial instruments. PMI then could be argued and viewed as an investment tool, a very sound one, and not actually a waste of money. If you have any questions on PMI or any of the stuff that we covered, feel free to leave a comment or send me a direct email, which is listed in the description. Otherwise, we'll catch you on the next one.